Here's how to calculate the whole life costs of your car or a car in your fleet. For this example, we've assumed that a car has a diesel engine which produces a combined fuel economy of 68.9 miles per gallon and a CO2 emissions figure of 109 grams per kilometre, and travels 60,000 miles, of which 30,000 are business miles, over a period of 3 years. First, take the purchase price of the vehicle. We've assumed a full on-the-road price of £21,275, but make sure you take into account any discounts or options and accessories fitted. Now add the fuel costs for the business miles over the whole length of ownership. This is calculated by dividing your total mileage, in this case 30,000, by the car's combined miles per gallon figure, which in our example is 68.9. This gives you a total of 436, which is the number of gallons of fuel used over the specified period. You then multiply the number of gallons by 4.55 to convert the total usage figures to litres. In this case, the total would be 1,981. Finally, you multiply the total litres used by your fuel price. For this example, we have assumed a national average diesel price of 121 pence per litre. This results in a total fuel cost for this example over 30,000 business miles of £2,397. Your total whole life cost figure, shown in the bottom right, is now £23,672. It will be important to keep an eye on this figure as we go. Next, if the car is liable to a London congestion charge, add in this figure for the whole length of ownership. In this example, we've assumed 2 trips a month into the London congestion zone, giving a total cost over 3 years of £828. Now add service, maintenance and repair costs. In this example, we've assumed a value of £1,600. Also known as SMR, these costs are set by data providers to the automotive industry. These projected costs will take into account the cost for the manufacturer's regular service schedules, together with an allowance for tyre replacement and general wear and tear. Next, you must account for vehicle excise duty from year 2 onwards across the whole length of ownership. Vehicle excise duty, or VED, also known as road fund licence, is a flat rate of £140 per year from year 2 onwards for all cars with CO2 emissions above zero, giving a total of £280 for our 3 years of ownership. If the list price of the vehicle, including options, but excluding first-year vehicle excise duty and first registration fee, exceeds £40,000, there is an additional £310 per year charge for years 2 to 6. Next, add the employer's Class 1A national insurance contribution. This is calculated using the car's P11D value, which is the taxable value of the car. More information on P11D is available in the What is P11D section of our website. The P11D of this example is £21,080. This figure is then multiplied by the benefit-in-kind tax band percentage for each year of ownership. More information about benefit-in-kind taxation can be found in the What is Benefit-in-kind section of our website. With CO2 emissions of 109 grams per kilometre from the diesel engine used in this example, the car would fall into the 23, 25 and then 28% benefit-in-kind tax bands for the next 3 years. Multiplying the P11D value of £21,080 by these percentages gives a combined value of £16,020 over 3 years. This amount is then multiplied by the standard Class 1A national insurance contribution rate set by HMRC, which is currently 13.8%, giving a total of £2,210. If you provide free fuel for private use, this is also subject to Class 1A national insurance contribution from the employer. For the 2017 to 2018 tax year, the P11D value of free fuel has been set at £22,600. This is HMRC's determination of the taxable value of free fuel as an employee benefit. If you provide free fuel, you would add this to the vehicle's P11D value of £21,080, giving you a total P11D value of £43,680. You would then run the calculation as explained earlier, but using this higher P11D value. And remember that the provision of free fuel for private use to employees would double your fuel costs in this example, as the mileage for which you pay the fuel would increase from 30,000 to 60,000. It's also important to include the cost of financing the vehicle and your insurance costs over its lifetime. In this example, we've assumed a finance rate of 4.5%. This percentage is multiplied by the purchase price of £21,275 to give an annual finance cost of £958, which is then multiplied by the number of years in the agreement, in this case 3, to give total finance costs of £2,872. We have also added industry average insurance costs of £2,880 over a 3-year cycle. If the car is an ultra-low emissions vehicle, emitting below 75 grams per kilometre of CO2, it may qualify for a plug-in car grant, which currently can total up to £4,500. This grant should be deducted from your total whole life cost figure. Finally, remember to account for the vehicle's resale value or residual value, as it's commonly known. These values are set by data providers to the industry. In this example, we've assumed the value of the car after 3 years and 60,000 miles would be £7,000. Taking this away from the total figure leaves you with the whole life cost of the car, £27,342. To summarise, fleet managers can reduce the whole life cost of running their fleet by following several key steps. Firstly, fleet managers should look for vehicles with a low P11D value, as this is the basis for the whole life cost calculation. Secondly, fleet managers should ensure they select a low emissions vehicle, as CO2 values are used to determine the taxation elements of your whole life cost. Choosing a low emissions vehicle will reduce the VED or road fund license you're liable to pay. A low CO2 figure will also be combined with the P11D value to calculate the national insurance contributions due, meaning achieving a reduction in both P11D value and CO2 emissions is very beneficial. Low emissions may also help the car qualify for a plug-in grant, which can further reduce whole life costs. Another key benefit of a low emissions vehicle is that fuel economy will be maximised and therefore fuel costs are minimised. Finally, fleet managers need to carefully consider the residual value of a vehicle, as the higher the residual value, the lower the whole life cost will be. So, to ensure the whole life costs of running your fleet are minimised, you should look to combine a low P11D value with low CO2 emissions and a high residual value.